I want to help me understand the difference between risk aversion and rotation, how big the line is between rotation and risk aversion when we're taking our cues off this bond market.
Certainly. I think you've seen this happen multiple times before. Last year's a great example. Every time the yields here spiked, the NASDAQ dropped. And so you have to look at some of these correlations and realize some of the growth at any price stocks, some of these high flyers or low revenues and high multiple stocks are really coming back down to earth. And people need to be looking and maybe less throwing at a dartboard and being a little bit more picky about where they are in this market. Financials, energy, industrials, materials, those stocks tend to do quite well in a rising rate environment, and they've done quite well as we've seen to start this year. And so the value trade, which started last year strong and then petered off a little bit, we think actually has some legs to stick this year. And so we want to look around this market and instead of, and understand what we own. I think too many people say, oh, the S&P 500, that's a broad-based index, but it's so cap weighted to tech. Honestly, it tracks the Russell 1000 growth extremely closely. So you need to understand that's a little bit growthier, and you might need to be looking a little bit deeper at finding pockets where you want to be. And so we don't think it's the end-all be-all to the end of the markets. We think you want to be in value. We think you want to be in large cap. You may start looking small just because it has some attractive valuations down there, but it's very much going to matter what you own and where you are going forward. And we think energy and financials are a great place to be.
Well, that's what's been winning right now on my screen. It was winning last week in a big way as well. Stuart, Kaiser, another way to ask the same question. When has the rate story become a problem for all of the market and not just pockets of the market?
Well, I mean, I imagine it has to do with obviously the absolute level, but also the pace with which you get there. I mean, I think that's what's really been disruptive the last kind of week or two is just the sharpness, of the move higher. What the ultimate break point is, I think that's, pretty difficult to determine. But I think there's a couple things at play here. It's the speed of the move and it's the flattening versus the steepening. Typically speaking, tech has actually done okay when the curve flattened last year, even if it was moving higher. Tech really lagged when the curve was kind of steepening out. So I think you kind of have a lot of moving parts here, but I think, from my perspective, our perspective, the catch up you've seen in rates has just been so rapid that's what's thrown people off balance. I mean, our house forecast was 180 for the 10-year for year end, 2021. We've basically just sort of caught up to that very quickly. Yeah. And now, on a go forward basis, the question is, I think, the market wants to be comfortable that, well, the Fed's gotten hawkish, the market's priced that already. So now we can kind of move on. But the challenge is if inflation keeps coming in for the next 3, 4, 5 months at the rate we expect, then the degree of hawkishness priced in is going to have to increase. And I think, that's really going to be the challenge over the next few months is does the market need to price a more hawkish Fed and at what speed does it do that?
Well, it's a challenge right now. The NASDAQ down another 1.6%. Losses last week mounting up to 4.5% there and thereabouts. On the S&P 500 down 0.9%. Breaking down the S&P at the moment. Financials, energy top of the pile. Consumer discretionary information technology bottom of the pile. Into the bond market with 10s up 4 basis points back through 180. Michael Kushma, often in the bond market we think about how self-limiting a sell-off might be. Can you help me through that one right now? Work through it with me. 10s at 180. When does this start to become self-limiting?
Well, part of the self-limiting is what we discussed earlier about the global context. How high do U.S. yields go relative to the rest of the world? How attractive does the U.S. bond market look relative to the rest of the world? With China slowing down and demand for lending or unwillingness to lend in China may maybe be subject to a excess savings problem. That money might leak abroad, either through official channels or through private sector channels. So the world being awash with liquidity is still true, even as the Fed tries to rein it in. So I think what really matters is, through the sell-off we've had before and the rise in yields, we're only getting back to kind of where we were last year. And the terminal rate, the rate at which people think the Fed will stop, hasn't changed all that much. It's still below 2%, which is really, really low. It's lower than it was at the end of the last cycle, even though inflation today has a lot more momentum than it ever has in decades. So the question is, if the terminal rate, the final rate the Fed needs to move rates to, moves higher, meaning the Fed hawkishness is not just about moving rates sooner rather than later, but the cumulative amount in 23 and 24 even keeps going up, then we can see yields rising even higher, 2, 2.25%, 2.5%, if we're talking about, a 3% Fed funds rate before this comes to an end. But right now, I think it's a bit premature to price that in, but I have been impressed by the market's willingness to continue to hold on to this idea that we will stay below what the Fed says is a 2.5% terminal rate on the Fed funds rate.
So far, at least. Listening to Bill Dudley, though, maybe that conversation changes and changes quickly.